Hi, I'm Sumit Malhotra, Managing Director, Financial Services Equity Research at Scotiabank. In the aftermath of the 2008-09 credit crisis, enhanced capital adequacy standards have been a major focus for regulators across the global financial services landscape. Despite their lower risk profile, the Canadian banks have clearly been impacted by this shift as well, as the sector ended Q2 with their Common Equity Tier 1 ratio at a record 11.4%, considerably higher than the 6.5% mark the group was managing with at the end of 2008. While a higher capital position makes a bank less vulnerable in the event of a downturn, the higher equity base does have a negative impact on the return on equity that shareholders receive. However, despite some of the challenges the sector has faced, the ROE of the Canadian banking industry has rebounded to a healthy 17% thus far in 2018. The three key sources for capital allocation at a bank are, number one, investing in the organic growth prospects of the business. Number two, returning capital to shareholders in the form of dividends and buybacks. And number three, adding scale and diversification to the bank via acquisition. We think that part of the recent upswing in ROE for the banks relates to the step up in capital deployment on the part of management. From an investor standpoint, there is a short-term versus long-term aspect when it comes to measuring the success of the capital deployment actions of a bank. While returning capital to shareholders via dividend increases and stock buybacks will provide near-term support to the shares, in our experience, long-term outperformance of Canadian bank stocks has been underpinned by the ability of management to drive recurring earnings growth via their capital investment of the business, whether organic or acquisitive. Historically, CIBC and National have been viewed by the market as banks that are more of a pure play on Canada. But in recent years, both have taken steps to increase their geographic diversification. With questions ranging from the health of the housing market to the economic impact of lower energy prices having acted as an overhang on Canadian equities, banks with greater exposure internationally have received a higher share price valuation from investors. Post the 2016 election, investors have also demonstrated a preference for U.S. bank stocks due to factors including economic strength, higher interest rates, and the benefits of tax reform. From an acquisition perspective, both Royal and CIBC have moved to increase their position south of the border in recent years, and when combined with the established footprints of BMO and TD, this now means that 4 of the big 6 Canadian banks have an on-the-ground retail and commercial banking presence in the United States. In our view, the banks that have been most consistent in the development of their franchises outside of Canada via capital deployment have been Scotiabank, TD, and BMO, a key consideration if the Canadian backdrop begins to slow. While Scotiabank has been active in the past 6 months, adding to its Pacific Alliance and wealth management operations, we expect to see TD and BMO follow suit by continuing to build out their U.S. presence, particularly with both banks ranking at the high end of the sector from a capital perspective. You can find more in-depth analysis and thought-leading content from Scotiabank on our website, and you can also follow us on Twitter @ScotiabankGBM. I'm Sumit Malhotra, and thanks for watching.